All right, peoples, happy Sunday and happy weekend. I wanted to put out something regarding the fear that we saw. I mean, there's some real issues, and I wanted to just sort of take them head on. I know some of you know I've talked about cycles, but I'm not going to talk as much about cycles. I'm going to talk specifically what's going on in the economy, what might what might we see in the markets, and the likelihood of a few different outcomes. If anything, to ease some of the fear and to put some realism on what the real issues are. So let's jump into this. So what's really going on with the US and for that matter the global economy, especially in the first world countries in the global economy? Are we already in a recession or simply heading into one? Will there be a soft landing? Um, for those of you that don't understand the idea of soft landing, most do. It's the idea that, yeah, inflation got out of control. We're stemming that, we're putting in rate increases, which we ran up historically in higher number of rate increases than we've ever encountered. We basically went from a quarter point or zero to like five and a quarter in a record period of time. While it's certainly not the highest that rates have ever been, it's the highest rates in the last 20 years. We were living with generational 100-year plus lowest ever inflation rates, interest rates. And you've seen inflation raise its ugly head. Now, that can't be blamed just on the rates, but it's a simple fact that you cannot pay off the massive debt. The difference in the rates that we have now is the GDP to our debt burden, which is huge. So when you start having the interest payments on our debt greater than military spending, which we've never historically ever had, then you're entering a dangerous time for one of the greatest countries in the world. Has been one of the greatest countries in the world. It severely is in a decline. And I can get into my cycle and tell you who takes over that and all of the other things that happen when the leading economy decays from within. But I'll spare you that and let you look at 6 months, a year. What are we going to expect in the markets? All right. While there will also be some unknown. So let's start with facts. We know the major indexes pull back hard on Friday on 8-2. There isn't anybody that didn't look at their portfolio unless all they owned was puts on the indexes or were short ETFs on the indexes that made any money. Now remember, traders can always make money. If all you do is day trade, it's possible to make money. But in general, those with a portfolio were in the red. So the Dow was down 1.5%, the S&P 1.8, and the Nasdaq 2.4. And I'll further add, should have put this in caps. I didn't realize that. Nasdaq now has retraced greater than 10% off its recent high. So a crash is typically considered 15%. Some say 20, a lot say 15. So at least alerted to that. It feels like a crash for those of you that have bought in near highs in anything. So what was the cause recently? What was the verbiage? Well, it was all around a weak July jobs report, triggered one of the most well known and historically accurate recession indicators. Some of you, I bet, have never heard of this. It's called the Somme rule, invented by Claudia Somme. Okay, so let me pull up something here that talks about it. There was an article in Fortune. It says a weak July jobs report just triggered one of the most well known and historically accurate recession indicators, the Somme rule. But The rule's inventor, Claudia Sahm, pushed back against the plethora of doomsday narrative that gained traction after its triggering on Friday. Oh, I'm not concerned at this moment we're in a recession, because a lot of times it's proven once it gets triggered, it runs aggressively. And I'm going to show you a chart in here. And then people said, well, we were already in it by the time the indicator tipped off. But to some fairness, I'm trying to give the benefit of the doubt. Claudia is saying, and it's her index, the Dow Jones Industrial, it gives you the numbers I've already given you. But some noted that household income is still growing while consumer spending and business investment remains resilient. Well, I question that, because we're seeing a lot of consumer spending that's being tightened, and people are cutting strings. Look at Amazon's guidance, Mayfair. I mean, it just goes down the line, even the previous quarter. So July's unemployment figure was likely also boosted by 420,000 workers who entered the labor force last month. And she brings up some of the immigrants coming in lately, and maybe that's changing. I don't know. Maybe what she's trying to do is it's only transitory. I don't know. But I give her more credence than normal, since she's the one that came up with the rule. But there's never been an exception to the rule over the last 15 recessions, dating back, 50, 60 years. So the US economy just added 114,000 jobs last month, and the unemployment rose from 4.1 to 4.3 in July, its highest level in nearly 3 years, the Bureau of Labor Statistics. Okay, let's take a look. I don't want to bore you with reading stuff or blowing up the screen so you can read it, but I do want this to be shown. So let's see if I need to blow this up even more. Let's do that. Whoops, that was too much. Okay, so here's the Psalm rule chart. And you see this dotted line? This dating back to 1975. Anytime there's a formula for it, but basically they take the last 3 monthly reports and they divide them, and they come up with, if it's over 50%, that is the trigger for recession. So look what's happened in the past. So this one, they're not showing you each month in the report, but understand on this line, these are monthly. So in 2020, a la COVID, it surged to 4% in April 2020, 2 months into the COVID recession. Okay. So 4%, we're at 0.53. So when it got going, it really got going. But that's not the first time in history. How about the banking crisis? 2007 into 2008 into 2009. The indicator hit 0.53 in February 2008, 3 months after the Great Recession began. See, they're saying a lot of times we're already in recession when it starts. So I appreciate Claudia saying that. So at least I can give you, you know, yin and yang, the positive and the negative. And I got a lot more, but look back historically. It never stops down at 0.53. Once it goes above that, it just soars. So is this going to play the same with us? I don't know. But it's definitely setting the scene for an interest rate in September. So while it may be premature to declare recession has begun, one thing was clear after Friday's job report and triggering: the likelihood of an economy and market juicing interest rate in September is now higher than ever. All right, so let me go into what I wanted to show you. So let's take a look at this. So I built this. So here's your upcoming FOMC Fed meetings. In case you didn't know, they're roughly about every 6 weeks. Most years you have 8 FOMC meetings. Stands for Federal Open Market Committee, right? You always hear Jerome Powell. You always talk about who the Fed chief is, the chairman of the Federal Reserve, and he's always the one that speaks. They're always 2-day meetings, almost always a Tuesday and Wednesday. They gather their stuff up on Tuesday and all come together and vote and talk. And then at 11 a.m. Pacific time, 2 Eastern, the chairman gets up and says, we've decided to hold rates and all of his Fed speak, right? And then sometimes he gets invited into Congress to do more. So here's the net. The net is, what's the probability of a rate cut for September at 25? It's over 100%. Right now, and I don't see anything changing. It's 100% a 25 basis point cut. There's an 80% probability that it's a 50 basis point. There's slightly under 50% that we get an immediate cut. What do I mean by that? Well, first off, normally the Fed, they may call an emergency meeting of themselves and we won't even know it. And then they'll take a quick vote and they'll say, we need to do this, and they'll vote it, and you won't even know there was a meeting. And all that means is that an immediate cut or emergency cut is one where it's not on their FOMC calendar. And trust me, if it's just under 50%, it could happen. So I'm trying to relieve some of the tension, okay? So we could see an interim immediate announcement of a cut. If that comes, I would say it comes in August, right? Because they're going to meet on, and I don't know if this is 18 and 19 or 17 and 18. I can pull up a calendar for September. Yeah. So when they're showing the date, they're showing the Wednesday, right? The 2 day meeting. It's always a Tuesday and Wednesday is sort of the decision or the announcement day. All right. So as you could imagine, there's a lot of pressure. The Fed is supposed to be independent, not a political organization. But trust me, if you're the incumbent now, the Democrat incumbent, you're going to be calling Powell on the phone and say, you're not going to let this thing run down on my watch, are you? You know, I don't care who the president, both sides do this, right? It's not a bipartisan thing because they know a rate cut will stimulate the market, give the market some confidence. It may not last very long, but it will stimulate. And you saw the what happened when they didn't cut, and then Friday. The other issue is that cuts take a while to come into effect, and I'll get into that in a minute. So Elizabeth Warren, Jordan, whether you like her, hate her, love her, she's definitely a polarizing figure. Um, Said she spoke her mind. She said Fed Chair Powell in a tweet on Twitter made a serious mistake not cutting interest rates. This came out on Friday. He's been warned over and over again that waiting too long risks driving the economy into a ditch. The job data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks, a la 918, right? So interesting. There's a bond king out there that I don't know if he tweeted, but I just heard about it. I didn't see it, and I didn't want to chase I probably could have been five more people of influence that said something. So let's go over what is the charter of the Federal Reserve. Well, first, the Fed has two mandates. It's to invoke monetary policies that facilitate price stability and at the same time promote maximum labor conditions. So I shortened it for you, peoples. Maximum employment and stable prices. Well, we have anything but stable prices. I think anybody could see that. Even an idiot could see that. Not implying that anybody is in that category, just simply saying we do not live in a stable price environment. The volatility is through the roof in many, many areas. So, this is you cannot change the direction of a battleship in a bathtub, right? Levers to change policy, you can pull them many different ways, but they take time to be seen in the economy. So, is the Fed waited too long? Is this time different? You know what they say when they say, that's Claudia Sahm. Is she just trying to, you know, not listen to her own rule? I don't know. Or is it the famous Powell? It's transitory. Don't worry about inflation. It's just transitory. right? So stopping market conditions for employment and the layoffs that have already been confirmed, which are a huge list of companies. I was going to put it up here, but it's just depressing. And those planned ahead can overwhelm the system quickly. All of the Sum rule chart. When it goes, it goes. So you got to take action. So here's something else in the world. You all know, well, I shouldn't say you all, but a lot of people have been discussing the US dollar and the Japanese yen. For those of you that know, I mean, Japan's been negative rates for 20 or 30 years. Back in 1987 was the peak of their stock market. They only recently, in this range, surpassed the 1987 highs in the Nikkei. Well, look what they've experienced just the other day. I think this is Friday, the last day. They were down 5.81%. What did I say? The NASDAQ was down 2.5. Peoples, that's more than two times that. Okay. And look, that's only this last run. They are off their highs significant. They're in crash territory. And it all sort of stems from their currency issue of some risk on and risk off assets. That should trigger some thoughts because that's what we're going through. All right. I don't want to get into politics and Japanese yen because, the Japanese, if you go all the way back to World War II and you look culturally, the Japanese and Asians in general have face to say. We bombed, what was it, Nagasaki the first time, Hiroshima and then Nagasaki, what order. But we literally had to do two bombings because of Japanese culture. They're very proud people. They're ferocious fighters. I mean, I give them, they're a true worthy adversary in the world. Thank goodness we've had peace terms with them, and it's a whole generation, for 80 years of peace. But the Japanese are a very proud culture, like a lot of Asian cultures. And so they tend to hide their own manipulation of the currency, whereas at least we come out and say what our Fed policy is. They'll do a sneak attack in the middle of the night and do something in their currency because they know they have to do it. So, and I'm not even complaining about them. It's just almost humorous. It really comes down to just cultures are different. I visited 63 worlds, 63 worlds, yeah. I'm out there. I'm a space cadet. I visit over 66 countries in the course of my work and in some vacations and trips. So I've seen a lot. And you learn so much in travel. You learn that people do things differently. But at the end of the day, I would say psychologically, we're all very similar. That's why stock charts work so well. When you really, because fear and greed, we all tend to react the same way. We may do it differently culturally. We may stand right up close in someone's face. We may want distance. I mean, somebody may eat with sticks. We eat with metal instruments. Some people eat with their hands, right? So, you can't dictate culture. All right. But some drawdown in the US markets actually will help with overall inflation. Remember, Powell's got two mandates. He wants to get inflation under control, but if he waits too long, he's going to destroy the employment, the market base, which we don't stand a chance then to generate spending. We need spending for our GDP to go up. Our debt against our GDP is at all-time high. So, on one hand, Powell's probably sitting there thinking, sorry, I pulled a tab in my Excel, and so that's why this ran together. Is a big pull on our economy. So Powell may want to wait. I'm giving you the pluses and minuses. So let's see how much political pressure he continues to get. Why on earth would he wait? He may wait because he thinks the inflation and the market, right? How much money is in the stock market? There's a lot of money in the stock market, a lot of wealth in real estate, and that's translated into a lot of people are in the stock market from their real estate wealth. and they can see with higher mortgage rates that likely they're what they own in housing is not going to go up. It's pretty hard to go up when you've got these kind of rates. I mean, there's been shortages and all that, but the amount of buyers that can qualify, most homes, the majority of the very high end, are all purchased with cash. They're not even taking out a mortgage. And most of these mid, priced homes that have more, and then corporations were buying a lot. So the housing market is under a lot of pressure, and that will ultimately help stem inflation. But I think Powell wouldn't mind seeing the market. I mean, we're only at 10%. So maybe if the market went to 18 or 20, he says, hey, that'll slow down things in the market. But I mean, I think that goes right along though with, the job cuts and all the other stuff. So it's a rock and a hard place. Um, the one thing that we know is that a rate cut, an immediate rate cut, along with the Fed and Treasury entering in the bond market to buy bonds, would certainly have a stimulative effect. And I would not be surprised if they're not forced politically and quelled to really do something. So, what else is out there that's harmful? And how can we look at this? Well, let's take a look at the global tension. Nobody can deny that the geopolitical and the global war cycle, I call it, um, has escalated for a number of years. I mean, my cycle people that I follow were saying 6 or 7 years ago that 2025 was the the real essence of a war cycle. And we're seeing it. We're seeing these hot flashes. What did we just have over the week? We're still in the weekend. Number one, what do you think's going to happen with Iran? They've swore that they're ready to launch a retaliate. We went through this sequence before, right? And we had the U.S. and Great Britain pull a lot of resources in, along with the Armed Dome and all the other things the Israelis had, and we shot down most of their drones and their hypersonic missiles. And that was a massive attack. So now that they've had a trial run, if they really want to hit inside Israel, they know maybe how to overpower that. I know the U.S. sent a warship, but all this is an escalation, right? This all costs money. So the U.S. is sending more warships to aid Israel. Our own political election coming up, we don't even have a Democratic full candidate, right? We have Kamala being said to be the candidate, but so far she's never had a single vote. Remember, she dropped out of the Democratic election. They went with Biden, and I'm sure if his health was in better condition, he probably would still be the candidate, but it's not. That's been pretty obvious to most of us. So they had to push him aside and push Kamala, but she doesn't have a running mate. And secondly, she hasn't been through the Democratic National Convention to be officially nominated, right? So our political system is being pulled apart in many, many ways because I don't think historically we've ever gone into an election and not had candidates that we knew were going to be the people that were going to be the candidate. So who knows? All I'm saying is this isn't normal. Our last few elections haven't been normal. Recent assassination attempt, right? That brought a lot of fear. All of these things collectively make investors nervous and worry. Okay. Two interesting assets here, right? The NASDAQ was just flying high, especially the Mag 7, right? And the NASDAQ 100. I mean, everybody was to the moon, to the moon. It was AI this and NVIDIA this, and just all of them are going to the moon. And I kept saying at that time, I'm not so sure. I see sector rotation. Then we started to have sector rotation. Now it's beyond, and the sector rotation was into the rest of the S&P 500 that wasn't getting all the money. And then it was in the Russell, and now we're just plain selling off. So Bitcoin and NASDAQ are both off, risk on, risk off, right? They're both incidentally around 10% plus. So BTC is 10.5 and the NASDAQ is 10.19. So while that doesn't seem that much when it happens in a fairly short time frame, that's a lot. So gold on Friday, the fear trade, reached a new all-time high early in the day. That and the GDX were doing pretty well. And boom, that drawdown pull them down. And that's going to happen. Especially in GDX and the precious, as much as I love precious metal miners and retired off them in the 2000 decade after the dot-com bust, the run up from 2001 to 2011. But I'll say that the end of the day, their stocks, when you have that, when we had that 2008 litany of just, the Lehman Brothers and all that, I had already started moving in some puts and things, but I still had some positions I lost big on. And what happened? Gold only went down 30%. It went from 1,000 to 700. You know what the miners went down? 80 to 90%. So when stocks are going to go down, all stocks go down because the margin calls and the liquidity, and then people start to have a chance to say, okay, it settled down, we're not going to crash any further. What's going to recover the quickest? And that's when your asset classes come into play. And that's what I've been preaching a little bit here. So what about our debt spiral? What are other things to make the market nervous, the economy and everything else? Well, we start to say a trillion like we don't even know what it was. And I think some of you heard my trillion before when I did the analogy in seconds. So if you had a trillion seconds, who knows how long that is in time? Well, it's like 31,309 years, I think. I could be wrong. Now it's been a while since I did it. But when you start to see it, whereas a million seconds is like, 7 days or something. So try to get a grasp on what $1 trillion really is. I really should have gone back and done that. But Google it if you really want to know. I remember 31,307 or 309, but again, I could be off by a digit. But it's massive. We just crossed 215 trillion of unfunded liabilities, mainly in Social Security, Medicare, and Medicaid. So when they're unfunded means we have all these liabilities to all these people. Well, one thing I can tell you, there are only two ways out of that. And one of them isn't going to happen. A default isn't going to happen. Okay. And the second one, to just say we're going to massively, it's political suicide. Neither party is going to come in there and say, oh, we're going to cut rates 50% in 2 years. They will say things like, at the rate we're going at, we're going to run out of money. And in 7 years, we're going to have to cut 20% of your Social Security, the amount you'd be collecting. But the reality is they need to inflate it away. The only way out of this thing is just inflate it away. And that's ugly. But I do see that coming in a 5, 7, 8 year time frame. Massive inflation, similar to the late 70s. Low teen inflation percentages. I don't see any other way out of it. And I think whether they lower now and kick the can down the road and stimulate the economy and the markets for a while, we're ultimately going to have much higher inflation over time. So on one hand, Powell is right to keep rates, but on the other, he does have a mandate not to kill the economy right now. So if there's some ability to kick it down the road, which I think there is still, he should probably take that path of least pain. So, here's one other thing. How do you increase productivity if you're laying people off and all the other? Well, you have an AI cycle miracle with productivity. But the way I see it, and based on everything that I read and study, I spend a lot of time looking up AI and trying to understand it. it's a 6 to 10 years out cycle for it to take over the whole economy. There's some leading companies, Palantir, Snowflake, some of these companies that have, AIP, and they have ontology and ways to get AI, because all you're seeing in these very early stages are your chip companies. Your AMD, and the biggest of all, NVIDIA. And NVIDIA is a fabulous, right? But most people think of it as GPUs, but it's beyond GPUs, right? It's that visual processing and some of those things that are driving the way processors need to be done for AI. But that's the hardware aspect. Yeah, I know they got CUDA software. Somebody always says to me, well, Bruce, they have software. But it's kind of related to their hardware, and it's an advantage. It makes their hardware advantageous over other hardware solutions, okay, for AI and that processing. But at the end of the day, the productivity growth has to get pushed through software. You have to see it do a lot more. Yeah, you need the hardware before you can run the software. The software is going to run needing the processing power of the hardware. But we got to have rollouts of all that software. So I see a minimum of 5 years before that really says we're productive. And that's going to kill a lot of jobs. Hopefully, people find other jobs. All right. We need spending to grow GDP and help pay down the debt. I'll give you an example of what I think has been poor progress, politically. And I'm not trying to pick a side here. I'm honestly not. We could have gone with an energy boom utilizing uranium, okay, but we opted for ESG. Now, Greenpeace people can say, yeah, but Bruce, we got carbon issues and we got that. Well, do you want you know, a death spiral on our economic world? So, I mean, there's a mixture. If ESG really works, that's great. It's, to me, that's where transitory comes into play. It's just like the electric automobile. You can't just go there immediately. We're making great progress in that. Okay. But the same thing with ESG. If you've been on oil and natural gas and uranium for years and years, okay, and you say, no, we're going wind and solar. And what happens when the wind doesn't blow? And what happens when we go into an Arctic environment, or we have a freezing wintertime and there is no sun shining? So that, the blades won't spin on wind, right? Whether there may be wind, but the blades are frozen. So you have a lot of things that says, yeah, you can get 2 or 3% of energy in ESG. I'm all for that. But that's been, I mean, we literally just outlawed drilling and said you can't drill. We've got to get back to having energy so that these, I mean, I don't know if you see what these big data centers and AI, they consume huge amounts of energy, and we need that. All right. So we still have to print our way out again to stimulate. There's no alternative right now. So I'm in favor of an immediate cut. Let's see if we get it or don't get it. If we don't get it, we could get more pain short term. Okay. And maybe that pushes Powell to do it. I'm not wanting that. I suffer just like you do. I haven't gone to all cash. I haven't done that and said 1929's coming and I'm going into my bunker and the whole world. Hey, people can think whatever they want to think. Um, so, what are some things? What should we be investing in and what should we be cautious in? This is my opinion only. Well, stores of wealth, BTC, gold, and a lot of commodities will benefit the most, along with a few select AI opportunities. All you have to do is go look at Yieldmax AIYY. There are some leading AI companies that we need. There's some also RANds that we don't have to have right now. And we also have to have the software front and center. So next, we may suffer short term, but one way or another, the markets need to get stimulated with rate cuts. And then over time, the sectors will change. So I pulled up one other thing for you guys down here. Oh, I have it here. All right. So I pull this out. I don't know that I buy it all 100% because I just said to you, stores of wealth like gold and Bitcoin. But typically in recessionary environments, what is stronger and what is weaker? Almost everything over here is weaker. Okay. I don't know that wine and spirits maybe wine and spirits, but I wouldn't think, there's a certain extent. I would want it when the markets are red like that. I go have a glass of wine. I turn my computer. But anyway, defense. There's a lot of defense stocks. I'm talking about the big military complex defense, right? AI, again, certain AI will do okay. But don't just pile into the NASDAQ thinking that everything's AI. Because listen, all the companies, they're no dummies. They're putting AI in the names of their products, whether they really have much of an impact or not. And investment banks, I really have to look at that. So anyway, guys, I'm not going to go on and on and on. I wanted to say to you that number one, what's caused it? We talked about that, right? We triggered the SOM rule. Why did we trigger that? Because the jobs report did not look good and unemployment's rising. Historically, when it starts to rise and it passes 0.5%, 50% of one, right? Half of 1%. We're at 53.53. Then that says we've reached recessionary. Now, Claudia Sam is saying, wait just a minute. So kudos to her. But please understand that they could go down further. I hope not. I hope we open up on Monday and things are great. But I know already gold, precious metals, and Bitcoin are the majority of my investments now. Okay. Having some AI, having some defense. I don't know about investment banks. I'll have to study it a little. I mean, know who they are, but I'd have to look at them in recessionary time. Bear Stearns didn't do very well in recessionary time. Anyway, guys, that's what I got for you. Hopefully, this was helpful. It's kind of long, but I tried to cover as much as I could and break down some of the complex things that the Fed speak says and put it into something where you can begin to understand it. Okay, guys, this is not financial advice. I'm not a financial advisor. Have a good rest of your weekend. Bye for now.